This is Keith Sprower, Chief Investment Officer here at Global Wealth Advisors, and this is the outlook for the first quarter of 2025. Given 2024 is officially behind us, I think it's important to spend a little bit of time on that market performance. And even with all the ups and downs we saw over the course of the year, I would still consider it to be a risk-on year for performance. As we look at the performance quilt here, you can see the far right column is for 2024. For the second year in a row, U.S. large cap returned over 20%, and that doesn't happen too often. As you look across the past 15 years laid out here, it was close in 2020 and 2021, but that's it. And large cap being up over 20% 3 years in a row is very rare. As you move down that far right column of 2024, you can see that small cap, high yield bonds, emerging market equities also did well. Again, riskier asset classes. Below that, the last 5 asset classes listed, performance was moderate, with the biggest disappointment being in the fixed income markets, and we'll get to the reason why next. As I've mentioned in the past, some of the bigger readjustments in all U.S. markets have been when the Federal Reserve outlook for interest rates and the market's outlook for interest rates are divergent. I think this graph shows just how much movement we've seen in the interest rate market in 2024. The orange curve is from the beginning of 2024. The blue curve is where we finished out the year. Over the past year, the Fed has messaged their intent to lower the Fed funds rate, which moved the yield curve from being very inverted, again, the orange curve, to at least normalized in the current curve from 1 to 20 years. Note that of the 0 month here, that data point on the far left is the upper bound of the Fed funds target rate, which dropped 1% last fall. One of the developments that has caught my eye is the change in the 10-year Treasury yield during the rate cutting of the Fed last year. The graph we're looking at here is the movement of the 10-year Treasury yield over the course of the past 12 months. It's a little unusual, but what we saw this time is that from September to the end of last year, the Federal Reserve cut the overnight rate by 1%, but in the same time period, we saw the 10-year Treasury rate increase by 1%. It's important to keep in mind that many interest rate-based products are based on the 10-year Treasury yield. The implications of this moving forward are that mortgage rates, credit card rates, personal loans, and so on haven't dropped as much as the consumer would have hoped. This could influence upcoming consumer spending and economic growth to some extent. Moving to the equity markets. One of the biggest concerns of the market today is, are equity valuations too high and can earnings growth continue? The graph on the left shows the path of valuations via the S&P 500 in the form of price to earnings ratios over the past 30 years. On the face of it, they do seem full, but let's keep in mind some of this is due to the valuations of the highest growth stocks in the index. Earnings remain strong on the right. 2024 earnings growth was around 9%. Forecasts are showing an increase of that to 14% in 2025 and increasing again by 13% in 2026. One of the biggest drivers of performance over the past few years have been growth stocks. As they appreciated, the concern of an overvalued market has grown. The chart on the left shows both revenue and stock appreciation for the Magnificent Seven. These companies have been very strong as far as growth is concerned, as you can see from this chart. Revenue growth has been robust for many of these companies, and the stock price appreciation for the same time period has been tremendous. The consensus thinking in 2025 is that the earnings that have been strong over the past few years on these stocks will slow, as you can see on the right, and we'll see earnings growth on the other 493 stocks in the S&P 500 increase, which should give us a better chance of broad stock performance in 2025. When you're trying to uncover a broad economic or market direction, you have to start with the data. And I tend to look at the data that can move the market. The labor market has a lot of these data points. The December jobs report came in strong compared to estimates. And you would think that a strong employment picture would be good for the markets. Low unemployment means more people are working, which means more people are spending, which is good for companies. But the market is looking through the lens of what it may mean for an increase in inflation and a possibility of a Fed policy error in response. And that could be not continuing to cut or even consider increasing rates. When this data came out, the market dropped significantly. So we're back to this time where good news for the economy is bad news for investments. I feel that we'll see this back and forth, but eventually get to a place where the economy globally gets to some kind of trend level. The markets are forward-looking, and when I see forecasts for economic growth, it looks to be moderating in 2025. This chart is from the Bureau of Economic Analysis, and the gray bars on the right are the forecasted quarterly GDP numbers, which are coming in lower than we have seen. A big caveat here is that over the past few years, GDP has surprised to the upside. Another show that the economy has been very resilient in the recent past. There are still a group of strategists out there that continue to look for a significant recession. They've been calling for one for the past 3 years. I haven't been in this camp given how strong the economy has been, and continue to believe that although some of the data has slowed, a full-blown recession doesn't seem likely this year. One of the indicators that I follow is credit spreads. When these spreads, which is the difference between the Treasury rate and various corporate bond rates, are widening, it has historically meant that we could see issues with the economy. You can see from these graphs that in the top graph, which is investment grade credit, the spread between treasuries and corporates is as tight or as small as it's been since 1998. And below that, high yield spreads are as tight as they've been since 2007. So at least this indicator isn't signaling any kind of recession. So what's coming that will help or hurt our assumptions? When I look at the headwinds and tailwinds, I want to point out that some of them are more longer term in duration than others. And the market outlook will certainly be influenced much more by the effects of a short-term headwind or tailwind. Regarding the headwinds, the concerns for the first quarter and beyond a bit would be how the new administration will implement policies discussed on the campaign trail. Things like tariffs, reduced regulations, and changes on taxes like tips and overtime and so on. There's also been a move from traditional assets, stocks, bonds, cash, to alternative assets, things like hedge funds, private debt, and private equity, both liquid, meaning you can get your money out quickly, and illiquid, which mean the investments have some kind of a lockup. This is a way for investors to include more non or low correlated assets in their portfolio, and certainly something we advocate for here. As more of this happens, there is pressure on the selling of these traditional asset groups, which could cause the market to go down. On the tailwind side of things, the economic data points that have been supportive are still supportive and in place. Inflation, GDP, the labor market, company earnings are all at levels that will support the market in the months to come. This doesn't mean that it's straight up from here, though. The last bullet point is an interesting one. Historically, what we've seen when a bull market is coming to an end is a move from investor optimism in the market and for the market to euphoria, which can be seen in confidence and sentiment numbers as well as anecdotally. You've read about this during the dot-com bubble in the late 90s. You know that everyone was talking about the market, buying tech stocks, and there was a lot of fear of missing out. This euphoria was the last leg before the market pullback. We haven't seen this yet, but when we get to that level, it could mean that there is a pullback coming. So let's summarize some of this. What I expect to happen in the markets over the next quarter or so. I do see some of the economic numbers slowing, particularly GDP. And I believe investors will make adjustments to their portfolios as we have seen them do at the end of 2024. So as a base case, if inflation stays around these levels and growth moderates, we could see a soft patch in the equity markets. I don't feel this will be prolonged. In fact, if we see a pullback, it will likely be an opportunity to buy for clients who have some cash. From everyone here at Global Wealth Advisors, thank you for watching. And if you like this content, please consider following us on the social media below. I'll speak with you next quarter.